Hi everyone, Damir here from Westmount Wealth Management. If the markets teach us anything, it's humility. The moment you think you've cracked the code, the market gently and sometimes violently reminds you that certainty is a mirage. Every decade seems to crown a new sure thing, and sure enough, every decade quietly retires it. Around here, we like to say nothing works all the time, but some things never change. Investing is a constant rotation of styles, sectors, and stories. Take diversification, for example. Everyone seemingly believes in it, right up to the point that it feels unrewarding. When US stocks trumped other markets over the past decade, your international allocation probably felt like a heavy anchor dragging your performance down. When interest rates rose, bonds lost their protective shine and probably felt just as pointless. However, it's critically important to remember that if every part of your portfolio is working at the same time, pointing in the same direction, and in similar magnitudes, you might be taking on more risk than you realize, and your diversification may be lacking. So yes, you can have too much of what appears to be a good thing. We see the same oscillating rhythm in the back and forth between value and growth investing. Historically, value stocks, i.e. stocks that are relatively cheaper based on metrics like price to book, have outperformed growth stocks by roughly 3 to 4% per year over long horizons. Then came the 2010s, when growth dominated and value looked rather broken. However, after inflation and rising interest rates returned, value made a comeback. The lesson here is simple. Styles have seasons. Enduring them requires discipline, not clairvoyance. Market timing tells its own story. The idea of stepping aside before the storm rolls in and jumping back in before recoveries is rather tempting. It's also near impossible. Impossible in the sense that market timing cannot be executed on a consistent and persistent basis. If you miss the 10 best trading days in the S&P 500 over a 20-year period, you're likely to cut your compound returns by more than half. The irony is that the best days usually show up right after the worst days. The rewards belong not to the precise, but to the patient. Even professional investors get caught in these cycles. A fund shines for a few years, gathers headlines and assets, then cools off once its tailwinds have faded. For example, the ARK Innovation Fund boom in the early 2020s, followed by the sharp reversal in 2022, is a recent reminder. Momentum attracts attention, but reversion to the mean never goes out of style. And then there are the so-called safe haven assets: gold, real estate, inflation-linked bonds, even cash. They all have their moments and their long slumps. Gold soared after 2008, then stagnated through much of the next decade, until last year where it's had a shining resurgence. Real estate boomed during the low interest rate environment, then cooled off once borrowing costs climbed. Even cash changes its character. In low inflation, holding it may feel rather prudent. During inflationary periods, however, its purchasing power quietly erodes. Even its safety is cyclical. So is cash really king? Look, if the moving, unpredictable parts of investing test your patience, well, naturally one has to wonder, what are the constants that give us confidence? What are some of the things that quote-unquote never change? To get to that answer, you very much have to go back to basics. Number one, you need to spend less than you earn. It's certainly not glamorous advice, but nothing else works without it. Cash flow management is critical in a sustainable financial plan. And not to beat a dead horse, but time in the market undoubtedly beats timing the market. Compounding is exponential. Missing just a handful of strong days can cripple long-term returns. Additionally, diversification, quite frankly, never runs out of style. It's the only free lunch in finance. So please make sure that you remain diversified across regions, risk factors, and asset classes. Every generation thinks its home market is safest until it's not. Japan's equity market, for example, took more than 30 years to recover from its late 80s peak. Your efforts should be dedicated to controlling what you can control. Your savings rate, fees, taxes, estate planning, and investment time horizon matter far more than forecasts. And make sure that you rebalance your investment portfolio periodically. Selling what's done well to buy what has lagged feels uncomfortable, which is why it works. And remember to stay humble and patient. No one knows what happens next. The antidote to uncertainty is not prediction, it's process. Additionally, try to align your strategy to your behavior and your goals. The best portfolio is not the one with the highest returns, it's the one that you can live with through thick and thin. And make sure to keep it simple. Financial products evolve rather quickly, but clarity and transparency remain timeless advantages. More so, human nature never changes. Fear, greed, envy, impatience, these are emotions that have driven every boom and bust in history. Recognizing them and building a plan that can withstand them is the real edge. Also remember that star managers fade and that cash feels safe until inflation bites. But thoughtful liquidity planning endures. Markets will always find new ways to test your patience. The right response is rather ancient. Stay humble, stay invested, and let time do its quiet work for you. At Westmount Wealth Management, we believe that lasting wealth is not built by chasing trends or fads. It's built through timeless principles applied consistently. We do not chase the next big thing. We build portfolios designed to weather change, anchored in evidence, discipline, and clarity. Thanks again for watching, and as always, if you have any questions, you know where to find us.